Guys, how nice would it be if you can generate $1,000 per week in passive income? How much would that benefit your life? How much would it move the needle on your net worth long term, especially when you factor in investing? Pretty good, I imagine. In this video, I'm going to be talking about just that. I'm going to show you my exact strategy and show you how you can calculate the formula that will allow you to generate $1,000 per week in passive income through liquidity providing, aka yield farming. So before we get started, I do have to say this video should not be taken as financial advice. Please consult with your financial advisor before making any investment decisions. This video is my own research and strategies, and it should be treated as such. Always do your own research. So in this video, I'm going to discuss what yield farming is, the best way to yield farm during a bull market, which I feel we're in the beginning stages of. I'm going to show you my formula on how to make $1,000 per day. And then I'm going to discuss if that should even be your goal and how to think about yield farming. All right. So without further ado, let's jump straight into the content, starting off with what is yield farming. So it's multiple ways to yield farm. Four main ways. You can help validate a network. So like staking on the ETH 2.0 beacon chain, get like a 13% yield. You can use your funds to facilitate borrowing and lending on something like Compound or Aave. You deposit your tokens, single-sided, and then they lend out your funds to people who come on to borrow, and they pay you a percentage of the fees via a yield. You can stake your funds on a platform like Nexus Mutual and use your liquidity to facilitate insurance premiums. And the fourth way, the most profitable way, my favorite way, the way we talk about on this channel all the time, is staking your funds on decentralized exchanges in the form of pairs so that you can make money whenever someone trades back and forth in whatever pool you provide liquidity in. So for example, let's say you're in ETH USDC on Uniswap. Whenever someone trades from USDC to ETH or from ETH to USDC, you make passive income, and the amount of passive income you make is based on your percentage in the overall pool. So if it's $100,000 in the pool and you have 10K, 5K ETH, 5K USDC, you're gonna make 10% of the trading fees. Going a step further, there's this thing called concentrated liquidity, and it allows you to provide liquidity on Uniswap or other decentralized exchanges as well, but Uniswap spearheaded this initiative. You can select the price you want to provide your liquidity in. So let's say you're in that same ETH USDC pool and you think ETH is gonna trade between the price of 2K to 4K, you can provide liquidity from $2,000 to $4,000. And a lot of people think this is new, but market makers have been doing this since the 19th century. Whenever you go on your brokerage to buy your stock, whether it's Fidelity or Robinhood, Webull, or whatever, it's not the brokerage that holds the inventory and stocks, it's the market makers. The brokerage is just the intermediary. So it's market makers that say, here's 100 million in Tesla, here's 100 million in cash. Only use my liquidity when the price of Tesla is between X and Y, and they profit off of what's called the bid to ask spread, aka trading fees. Is literally the same exact thing as yield farming. They even have to worry about impermanent loss. So now if we cover what yield farming is, what is the best way to yield farm during a bull market? Like a lot of people are worried about impermanent loss, like, oh, what if it goes up? Well, there are strategies for bull markets, bear markets, and sideways markets. And if these strategies weren't profitable, these market makers wouldn't be doing them because profits is their number one motive. So there are ways to yield farm in each market. You just have to know what you're doing. For bull markets, it's two things. One, if you're doing concentrated liquidity, you want to set your range high because you can use it to take profits. Whether if it's a volatile pair or a volatile stable pair, you want to give it room to run on the upside, opposite on the downside. But the best pairs to look at during bull markets, especially for concentrated liquidity, is volatile pairs. This is altcoins paired with another altcoin or Bitcoin paired with altcoins. And the reason why is because if you're doing concentrated liquidity, you have a higher chance of staying in range because in a bull market, they say a rising tide raises all ships. If one altcoin's pumping, the other one has a high likelihood of pumping as well, and it offers you a higher chance to stay in range. Let me show you proof. Okay, so here we are at the Clearpool USDC chart. Now we're gonna compare this volatile stable liquidity pool versus a volatile liquidity pool and how the results would have been different. So as you can see here, on February 12th, you saw it pretty much pump 85%. Guys, also, I called Clearpool out in my group to our paid members before it pumped. So our members got to experience a 90+% pump. If you're interested in getting access to our buy and sell calls and you want to become a yield farming professional and be able to accumulate high quality assets so you can sell them at higher prices once the bull market is in full effect, click the link in the description, book a free strategy session, talk to one of the members of our team. We'll see if our program is a good fit for you. We only look for a certain type of person and we only let in a certain amount of people in. So if you're a self-motivated individual who is looking to be a part of an elite group of like-minded people, then this is something that could be of interest to you. So if that's the case, we look forward to speaking with you. Back to the video. So you see here, it pumped 86% on February 24th, but keep in mind, it pumped that much against USDC. But if you look here on February 24th, you can see it's actually down against ETH. And if this is the range that I'm providing liquidity in the Clearpool video, I made a video explaining this yield farming strategy. I'm not sure if it's out yet because I film all these videos in one day, but it'll be out soon. But you can see on the 24th, it would have went out of range if my range was the one that was specified on the chart right here, right? You see that huge pump? This is against USDC, but against ETH was rising as well. So there isn't too much volatility, which means more money for you because you have there's a lesser likelihood of you going out of range. The cool thing about this is if it does go out of range to the upside, because we're in a bull market, you're able to take profits in ETH. And instead of taking profits in USDC, it's good to take profits in ETH because ETH is going to keep rising. So even if it goes out of range, ETH could catch up. ETH could surpass, Clearpool could catch up. But at least you're taking profits in something that's constantly rising, even if it isn't rising as much as the asset that is paired with. And I always say, as a general rule, you never want to provide liquidity for any pair of assets that you wouldn't mind holding on their own, right? So the first thing you want to do is find the assets that you want to provide liquidity for, or find the asset you want to accumulate. Like, let's say you want to accumulate Clearpool. So if you want to accumulate Clearpool, you go on CoinGecko, you scroll down, you see where most of the trading is happening on decentralized exchanges. You can see that is happening on Ethereum mainnet, Clearpool, and ETH, right? You got Clearpool USDC, but it's only 10% versus 17%. I come here, I type in Cpool, and you can see that the Cpool ETH has a TVL of 273K, but the volume is more than double the TVL at 482K versus a TVL on the Cpool USDC chart of 738K, and the volume is only 300K. The smaller the TVL, the easier it is for the pair to have a good volume to TVL ratio because the TVL is already small. It doesn't matter what size it is. If the volume is more than the TVL, you're going to make some good profits. And just to show you proof, I've been in this Cpool ETH position for 18 hours, not even a full day. I've already made over 50 bucks off of a $5,000 principal. And right now I'm getting an APR of 485%, 731 not including fees. Guys, and I have to do absolutely nothing. This is crazy. So not only would I have made less money if I'm in the Clearpool USDC liquidity pool because the volume to TVL ratio is lower as I just showed you guys, but also you see how it's way more volatile as these swings are a lot bigger. So I would have to set my range wider, which would lower my passive income even more. So just to put a bow on this, I like volatile stable pairs if I'm just trying to take profits in USDC, and I am in some of them. But since we're in a bull market and I think everything's going to pump, I might as well pair up assets that are more correlated versus an asset and a stable coin because I know the asset's going to leave the stable coin behind. So now if we cover that, I'm going to show you guys my exact formula for how you can make $1,000 per day. And I'm going to show you the formula to calculate it on your own. And stick around to the end because I'm going to talk about if that should even be your goal, your motivation, like how you should actually look at yield farming when it comes to your yields and how much you want to make per day, per week, per year, per whatever. So guys, obviously I only have $5,000, $5,502 in this pool. How much would I need? All right guys, so we're going to look at my Maple ETH pool. And I've talked about this many times on the channel. I've been in this pool for 11 days. And right now I have over $1,200 in unclaimed rewards. And I've already claimed the rewards once and sent them to another wallet and bought more Maple with it. So it's actually more than double this since I've been in the pool, which is really crazy actually. And the range is pretty wide. That range is from this top line to this bottom line. As you can see, I'm giving it plenty room to go up. And what will happen if I go out of range here is I will be in 100% ETH, but that's good because I think we'll see a 15K ETH in this bull market. And I think Maple will 100x from this current price. And I made a video on that. Definitely give it a watch if you haven't. So what would I need to have as a principal in order to make $1,000 per week in this pool? Well, it says here I'm getting 264%. So basically, I would need $19,000. And let me show you the math. $19,000 plus 264% is $50,160. If you divide $50,160 by 12, that gets you $4,180. And that equates to you making $1,045 per week. Now, you don't have to have all of it in this Maple pool. As you can see, I have multiple pools in here where I'm getting yields. So you can do the formula and, add in other pools, but at least you know how much you need to have getting an APR of $264. Whatever your APR is or desired APR is, you just do the same exact math. So now for the most important part, should you aim to make $1,000 per week, or should you aim to make a certain amount per whatever? My answer to that is no. It's kind of like, if I have to give an analogy, it's basketball. Kobe Bryant or LeBron James, the greatest players, maybe not Carmelo Anthony, because he really cared about scoring. They don't go into the game and say, I'm going to score 50 points. I'm sure Kobe Bryant didn't say in the game he scored 81. He didn't think he was going to have 81 points that night. His goal was to win the game, and he did what he had to do to win the game, right? It's the same thing with investing. Your goal should be to appreciate your portfolio in a risk-adjusted way, just like their aim is to win the game while preserving their energy so they can play in the next game and prepare for the playoffs. It's the same exact thing. So if your goal is to win the game of portfolio management, you have risk adjustment, your yield farming, everything is set up intelligently. What I mean by that is, instead of trying to make $1,000 per week, you set your ranges accordingly. You find pools with high volume to TVO ratios. You back test them on builder metrics like I've shown in many other videos, and then the results will follow. I didn't know I was going to be getting 264% APR. Sometimes it goes up, sometimes it goes down. It depends on volume, but my range is set intelligently because I'm giving it room to run and take profits in ETH, and the results follow. It's the same thing when I used to trade Forex. They would say, don't chase the money, chase the skill, and the money will follow. It's the same exact thing in yield farming. So guys, I hope you got value from this video. This is the end of it, and I like to conclude. Like I said, if you're interested in this kind of thing and you want to learn how to do this like a professional market maker, click the link in the description and book a free strategy session. Other than that, if you got value from this video, I ask that you drop a like, drop a comment. Let me know what video you want me to cover next, what yield farming strategy, what token you want to accumulate, anything yield farming, just let me know. I'm always trying to think of new ideas of content to make. And lastly, if you got value, I ask that you consider subscribing. But with that, I thank you so much for tuning in. I love every single one of you, and I'll see you in the next video. Take care and trade safe.